Thank you all for coming in this morning to join us. And a little bit correction to what Umar says. It's a Middle Eastern and Desi panel. We're blessed to also have Sujude join us. 10 seconds introduction on me. Been doing investing for about 20 years. I was an entrepreneur in a past life and an engineer a long time ago until I got fired after 3 months. So I moved on to the business side. But what I want to do is give a brief introduction to our panelists. We're going to spend about 25 minutes hearing some of their perspectives. And then to make it interactive, we will take questions from the audience. So starting here on the left, I have Omar Siddiqui. Omar I've known for about 20 years. Omar is a graduate of Harvard as an undergrad where he was on a squash team. He was in at McKinsey. He did a startup. He went to Stanford Business School where he was an R.J. Miller Scholar. I think before that, he was at Bain Capital Ventures. He did another startup, after which he successfully sold to Disney. And now he's doing another startup, and he runs a pre-seed seed fund. Omar has more brands than Neiman Marcus, so he's a proud member of our community. Next to him is Tarim. Tarim is a undergraduate from Dartmouth. After Dartmouth, he joined Bain Capital, which is a very large private equity fund. He's at the extreme end of the spectrum of investing, and so you're going to enjoy hearing about some of his perspectives. Harvard Business School, and now he is at Hellman and Friedman. Hellman and Friedman, let me give a little bit of context. So we've all heard of firms like Sequoia, Benchmark, Excel, and Andreessen Horowitz, which are the premier firms in venture capital. In private equity, Hellman and Friedman is one of the premier firms. They do large deals. They're alongside KKR, Blackstone, TPG, and Tarim is one of the very few members of our community who's an investing partner. They manage about $80 billion in assets. And for the Pakistanis amongst you, to put that into context, that's about 11 loans from the IMF. So Tarim alone could solve a few generations of our funding issues in Pakistan. And then we have Sangeen Zeb. Sangeen was born and raised in the US, correct? And he's a very proud member of our community. Sangeen is a double graduate of Wharton, both undergrad and master's. He started his career at Summit, a growth equity firm, but now he's at Google Ventures, where he does mid to late stage investing. And in particular, I want to welcome Sangeen's parents, who are here. So welcome. And they're attending to get the perennial question that they have, that many of our parents had, is, son, what do you do for a living? So hopefully they're going to find out today what Sangeen does. And then we have Usman Rabbani. Usman is currently at Brighton Park Capital, based out in the Bay Area. It's a growth equity firm. He's an undergrad from Yale. He did a master's from Harvard in computer science. He's actually a software engineer, so he's actually has had a real job for 10 years. And then most recently, he was a partner at McKinsey before he entered the private equity industry. So he's also got a very interesting background we look forward to hearing about. And the best and brightest amongst us is Sujude. Sujude grew up outside of Akron, Ohio, in a town called Hudson. She's a scientist, studied chemistry, worked at a lab just outside of Berkeley. And then she did a master's at Stanford, and through that she was able to enter the venture capital industry, first at Lux, and she's currently at a mid-stage venture capital firm called Jazz Ventures. So I really appreciate the panelists joining us. So what I'm going to do is I'm going to ask the panelists to talk a little bit about their specific investment strategy, and maybe also prompt them to talk about one or two kind of piece of advice they got during their careers, which has taken them to where they are. And we'll start from the real early stage investing with Omar, who runs a pre-seed seed fund called Graph Ventures.
So for those of you who are less familiar with the investment industry, pre-seed and seed investing refers to the very first capital that is typically going into a business. And so we started Graph Ventures in 2010, mainly as a way of, we were a group of friends coming out of business school who had had some entrepreneurial success. And after that entrepreneurial success, we were being approached by people in our network to give them advice and frequently to provide them some small angel checks as well. And so in 2010, we just thought that it would be a lot more fun to lose our money together as a group than to lose it on our own. And so we banded together and figured that we would start writing these checks as a group and harness our kind of collective networks and our collective perspectives in helping these companies that were just getting off the ground. And so at that very early stage, you really have nothing to diligence. There's nothing to look at. There's nothing to do research on. You're really trying to connect the people with the opportunity. And so what we are really looking for is the fit between the founder or the founding team and the problem that they are trying to solve, number one. Number two, we're looking at their plan, not because we expect it to actually remain as they anticipated, but rather to make sure that it just makes sense because it demonstrates the quality of thinking with which that team is attacking the opportunity, right? And thirdly, we look for an instinct around what is driving this team. Like, why are they doing this? If it's an amazing economic opportunity that they know nothing about, but they're just mercenarily attacking it, that doesn't necessarily automatically disqualify them, but they better than have a lot of evidence that they're the kinds of people who are going to stick with it when it doesn't look so economically attractive anymore. Because I guarantee you every opportunity that looks economically attractive turns out to be horrible and awful and grueling and a death march before it's over. But so you're looking for why this team will stick over the course of what is going to be an extremely arduous journey. And so since 2010, we've now written about 300 plus checks into early stage ventures. We remain actually an operator fund. And so that's one of the things that has been interesting about pre-seed seed. We have not had a full-time investing partner ever until about 2 years ago in the fund. And 2 years ago, the partner we added was mainly to support our companies. Because what we found, for us at least, has been our value proposition. What makes us different is the fact that all of us are busy gaining our own scars, running our own ventures, while we are connecting with and supporting other entrepreneurs. And so for me, I think career-wise, what led to this was really a passion for building new ventures. And I got that exposure in many different ways before I became an investor or before I started investing. I got it in structured environments like McKinsey and Bain Capital, where you develop an approach to understanding problems and articulating solutions to them. I got it in design and product as a way to actually build something of value, right? And then I got it as an entrepreneur, actually trying to put those things in motion. And so for me, I think getting those experiences before you start venturing out to support others with capital or advice has been extremely important and valuable, at least in my experience and my journey.
That's great. Maybe Sujude, you can talk a little bit about yours. So Omar, as he described, is seed, pre-seed, very early stage, and Sujude is early to mid-stage venture. Tell us a little bit about what that is.
We focus mostly at seed and Series A. I'm also a generalist, but lean towards companies that do have a deep tech component and a longer commercialization timeline. But I think when we look at companies, our thesis is pretty surrounded on founder-company fit. If the founder is the right profile to stick with it, if they have the grit, if they're obsessed with the problem, and they have that ability to build a team at that stage because they already have some capital in. And on the second front, I think because we look for that technical advantage, we also look for business model innovation. How are they going to go to market in a way that usually pushes a slow-moving industry to move a little faster? But those are the two pillars of what we look at. I don't know the other question I'm supposed to answer right now, but if you could remind me.
Just a little bit about your career path. Just tell us what's the best piece of advice you received along this journey?
I think entering venture capital, I was coming from very logic-based. I started off as a scientist, then worked in product, and venture didn't make sense at first. A lot of the valuations felt very loose, and how people would give money or not give money, I realized was an art and not a science. So I think the best piece of advice I was given is that anything makes sense if you make it make sense. So so that's kind of the motto I move going forward. I still look at comps and I understand how pricing works, but the ecosystem moves so fluidly and quickly. You have to pick up things in a way where you change your mental models every day. Nothing is a stagnant mental model.
That's great. Thank you. Maybe Sangeen, you can go next. So Sangeen is at the monopolistic Google. He's part of the Google Ventures team. Tell us what that's like and what the investment strategies that you pursue.
Google Ventures actually strategically is super easy to explain. The founders of Google wanted to create a venture fund that had nothing strategically to do with the LP. So structurally, there are LP, which means we can invest in a bunch of awesome companies that have nothing to do with Google. And for us, that's like Plaid, Toast, Stripe. But even more importantly, we can invest in a bunch of companies that compete with Google. And that includes Uber, which competes with Waymo. Slack was competing with Gmail at the time. But our North Star is to go find the next Google. And that actually makes the job pretty easy. So for me, before GV, I was an investor in companies like Robinhood and Databricks, where I think the market opportunity was unbounded, but the humans who started those companies also have unbounded potential. And then at GV, look, a lot of what we do today is AI focused. I'm an investor in a company called Harvey, which is one of the fastest application AI companies, fastest growing application AI companies in the world. A company called Hebia, which does AI for financial services. And we think the founder, George, has the potential to be the next Elon Musk, right? So it's a blend of math, but also just belief in the person. And I'll give a quick shout out. Raz knows this person, but I'm an investor in a company called Fabric, started by a young man named Anik Rahman. Anik sold his first company when he was 29 to Oracle for $850 million. Fabric will probably be a unicorn by the end of this year. I think he's the best young Pakistani entrepreneur in the world. He always tells me I'm wrong because he's actually from Bangladesh. So, but Anik is extraordinary, and so we're lucky to just partner with incredible people.
Great. Maybe we'll have Tarim go next. So Tarim, what's a nice, good-looking, smart guy like you doing in private equity?
Let me describe private equity a little bit for folks, because I think in the Valley, VC is a very popular and commonly sort of understood thing. So private equity is really the later stages that come after a company is somewhat mature. It's a huge asset class. It's literally sort of the fastest growing, one of the largest asset classes at this point. There are more private equity-backed companies over time than public companies. So the public companies are actually, there are fewer of them. More of them are going private. So think of it as just another big late-stage asset class. And there are all flavors of it. There's no one kind of private equity. There are thousands of private equity firms. What we do is growth at scale. So we are looking for companies that are still really great companies that have a few $100 million of revenue, and we think are going to have a few $1 billion of revenue. And we're trying to get in at the right time, same as VC firms in that way. But the challenges at that scale are just different. They're much more operational. You really have to figure out how to build scale, how to mature as a company in terms of your processes, systems. In some cases, you have to figure out second acts, third acts of, what's actually going to be the next growth vector for this company. So there are similarities to early stage, but, a different skill set, a different mindset that goes with it. I really enjoy it. So Hellman and Friedman basically does concentrated investing. So we have a small portfolio. We only have 30 companies. So that 80 billion of assets under management is 30 companies. And we are trying to find things that are long-term compounders and things that ideally we can stick with for 10 years if we can. And the kinds of companies are, just to give you examples, would be DoubleClick was an investment. We took it private. It was a public company and we sold it to Google. and it is now powering Google's ad machine, which is obviously a massive, massive thing at this point. We're investors in NASDAQ. We own Zendesk right now. These are all companies and names that you would have heard of. And in some cases, they were they'd hit a speed bump. So double click in the public markets, people kind of were like, ad tech is not that interesting anymore. We dug in, we really liked what they had. We saw the future and we said, let's actually take this bet. By the way, there were 20 other ad tech companies that were really bad bets. And so you really have to do your work. In terms of advice, I'd say the biggest thing that I would want people to know is to surround yourself with really talented people that you look up to and that are better than you. And I think that was my journey, which is at every step, I felt like I was not the smartest person in the room and I needed to work really hard in order to keep up and be good enough to belong where I was. And that was true in college, that was true in my first job, that is true in my current job, and I think it served me really well.
That's great. So we've had venture, and on the other end of the spectrum, we've had private equity. And now we have Usman, that's growth equity. So you're not venture, you're not private equity, you're the non-binary of this industry. Tell us a little bit about growth equity. What is growth equity? And tell us a little bit about your professional experience.
Yeah, so I think one way to think about it is you heard from the bookends, which is venture capital and late stage private equity, and growth equity is right in the middle. So another way to visualize it is venture capital is 5 people and a napkin and a dream and perhaps a prototype of a product looking for anywhere from $1 to $10 million or something like that. Late stage private equity is a large company that has been around for perhaps 10, 20, 30 years, where you can invest billions of dollars of equity into that company and do a takeover or a buyout. In the middle are companies which are too big for venture capital, but too small for private equity, that may need $100 million or $200 million to get from 100 people to 300 people, to build a go-to-market, to get the next product out. But there are companies that are well beyond the venture phase and have products, they have customers. The companies we invest in usually have $20 to $80 million of revenue and are 100 to 200 people, in size. And we focus on companies in B2B tech. So we invest in healthcare IT, which is a very important priority for us. A lot of interesting things going on there. We invest in IT services, which are all data-enabled services, IT services, software development, outsourcing firms. And we invest in enterprise software, which is a big category that includes cybersecurity, infrastructure security, AI, vertical AI, and other things. And that's sort of the flavor of what we do. I think on the second point, Raz, advice. The best advice I got was early on in my career. I was 100% certain that I was going to be a physician, and so I studied biology and chemistry and organic chemistry, and I was pre-med, and did my summers in bio labs and things like that. And at some point, I kind of realized that I didn't really like medicine that much, and that was after working at a hospital. And somebody told me, don't let your past be a drag on your future. So just because you've invested all this stuff, don't let that be the reason you decide to continue down a certain path. And I think that's the best advice I ever got, because I've done that now 3 times in my career. Once where I gave up trying to be a doctor, once where I gave up trying to be a software developer, another time where I gave up being a management consultant, and now I'm in this world, and who knows what I might do next. So
Thank you for offering that advice for a lot of young folks whose parents want them to be doctors. Appreciate that, Usman. I know I'm going to take some questions from the audience, but maybe one final question I can ask the panel, each of you can opine, is that we're living in interesting times. The investing industry broadly has been subdued for a number of reasons. Venture capital has got an overhang. Stock markets have been down. We have a new administration that's going to come into government early next year. So when you look out, and particularly for this audience, over the next 3, 4, 5 years, what impact do you think it's going to have on the investing industry, your style of investing, and in particular, anyone who's thinking of starting or buying a business or joining a growth business? What's your guidance, your thoughts, your opinion, what the next 3, 4, 5 years look like in your respective fields?
I mean, particularly directed to the young people in the audience, at least in the venture world, this is the greatest time I think you could imagine. The amount of innovation we've seen because of AI has been incredible. Like, at least once a day, we have a company pitch us, and I'm blown away at the endless possibilities of what they're creating. And so, as a parallel, like, we're in 1996, 1997, like early internet days in terms of the unbridled potential of all of these technologies. So over the near term, over the next 3 to 5 years, I think we're incredibly excited by the amount of innovation we're seeing, the amount of talent, the amount of energy we're finding from our entrepreneurs.
And to juxtapose that, I think the investment community is getting quite a lot smaller. I've seen a lot of friends leaving the industry. So I do feel like the people in the positions of being a capital allocator are becoming less diverse and less people that look like us. I think in the next 3 to 5 years, we're going to see a shift kind of backwards on how investors look and how investors see the background of a founder and how that background of the founder will equate success. So that's a little nerve-wracking, but outside of that, that just gives us all motivation to keep going and to be more creative on who we approach and how we pitch.
I'll just add that in the past, 5 to 10 years, there's been so much money raised across venture growth and buyout. The data is just staggering. There is so much money out there waiting to be deployed that the balance of power is actually on your side. The entrepreneurs, people who are building stuff. You wouldn't believe how competitive it is to get an entrepreneur to partner with you and for you to invest in their company. I'll echo some of the sentiments. There's been no better time to start a company, to build something, et cetera, because the capital is out there and the capital is looking to get deployed.
I would actually offer an alternate perspective where I think there is a lot of capital out there and there's a huge overhang. And the way capital works, your IRR clock as an investor starts when you call the capital. And if you don't deploy it, it's not a good thing for you at all. And so, yes, there is that drive. But on the other hand, I also think there's a real flight to quality and conservatism on the part of where the capital is being deployed. And so, yes, there's never a better time to have a company that is fundable, but the bar on what is considered fundable, I think, is a lot higher than it has been for probably 5 to 10 years. And so, yes, it is hyper competitive if you're fundable. And if you're not, you're just DOA. And I don't think there's any real there's much less ambiguity over that now than it was in the past. I've also, to be honest with you, in the last year or two, not found the AI wave particularly inspiring at all. I actually do think there's fundamental technology shifts happening, and there are amazing new solutions and amazing new capabilities. But I don't think many of those capability shifts are going to turn into amazing companies as startups. I think they are amazing technologies, but not amazing startups. There will be the winners that create, billions and trillions of dollars of value, but I think there will be a lot of carcasses and a lot of overvalued companies left by the wayside. And so as an entrepreneur, you have to remember you don't have a portfolio. You are all in on a portfolio of one, which is your company, right? And so be extremely careful in taking an entrepreneurial bet, right? Like, I don't agree with the general sentiment of like everyone should be an entrepreneur because it's wonderful and inspiring and an amazing life and an amazing career. It's horrible. It's a slog. It's lonely. It's depressing. And every once in a while, you might get lucky and make a lot of money. But most of the time, it's horrible, right? So only do it for something that actually matters. Because otherwise, you're just wasting your life energy And you should spend that life energy on something that really speaks to you, and do it for things that matter. Don't do it for things because it's on trend or is simply the flavor of the month. It has to be an amazing technology, and it has to turn into an amazing business for it to then be an amazing investment opportunity for anyone. And that bar is higher now than it probably has been in a very long time.
I'll share a slightly different maybe vantage point. At scale companies, there's a real dearth of operating talent. That may sound strange to people, but especially in technology, the last 10 years were kind of go-go times. And, you really didn't need to be a great operator to be successful. You were riding a wave. There was lots of spending from customers. There was lots of spending from investors. So when we sit at our vantage point and look at these larger companies, one of the big debates we're having is how many are actually going to be run by really strong operators in technology. And when we look around, there aren't a lot of them. And so if you are an operator and you're not at the early stage and you're an executive, being a great operator, actually, this is a great time to do it. And many great ones are going to be sort of hardened in this period when it's not that easy at scale. Lots of companies have, gone public and aren't doing so well, and they're struggling to figure out how to grow and have profitability. This is a hard job, but if you are one of those people, you're in demand right now at every company. Lots of money gets thrown at you. So a little bit, as I said, from a different end of the spectrum, it's a great time to be a good operator. And there's a lot of demand for it.
So operators, come see Tarim.
Anytime.
So look, we're going to take some questions from the audience. This gentleman here, can we give the...
My name is Usman. I'm on the board of Open London. I wanted to ask you about any of your perspectives in terms of the risk appetite for the businesses that you work with and invest in to scale internationally. I'm particularly thinking of growth markets in parts of Asia, indeed parts of Africa. I've just come back from both regions, and there is clearly a strong demographic push in some of those markets. There are significant changes growing middle class, all of that stuff. So to what extent do you think, and you mentioned the new administration, we don't know what's going to happen with the T-word, tariffs, etc., but obviously the potential in those overseas markets is significant. To what extent do your businesses have the opportunity to scale into some of those growth markets?
I'm happy to share my perspective from the companies we spend time with. There's no one single answer to that question. First of all, it's just different in different geographies right now. The Middle East is booming, so every single company that has access to the Middle Eastern market, every single investor that has access to Middle Eastern capital is there. And I think people are quite excited about the opportunities there right now. So that one, I think, lots of appetite. I'll say from the scale companies' vantage point, China is a bit of a no-go zone for a lot of companies right now, given the political tension between the US and China. So we are advising against it in many cases. So it truly is, Europe, frankly, the economy is fine-ish, not great. So it really is sort of geography by geography. In general, this lure of international expansion sounds great. The lived experiences, it's hard to do. And so when we find companies that are actually good at it, we're quite excited about it. But often it's like the fifth bullet point on the PowerPoint that says, and we have this amazing international opportunity. And it's sort of like, it's upside.
As the Middle Eastern person on this panel, the Middle East is interesting. I do feel like it is an example on how you can't translate the U.S. innovation ecosystem overseas. I think in the past 10 years, there's been government mandates to build out venture firms across the region. I think a lot of those regional firms have their budgets cut in the next 10 years because the startups are not at the same stage of maturity to validate the same amount of capital in that market. So to answer your question, a firm that's US-based trying to scale overseas, specifically for Middle East, and I know India, you have to have boots on the ground. Africa is a different equation, but and every ecosystem is different. But I do believe certain ecosystems don't need people like us to scale there. They have investors in that region that are looking for regional startups.
In the stage at which we invest, the companies in our portfolio have built a business largely off the back of the North American market. And usually it's largely the United States. And they are at a stage where they're starting to think about international expansion. But as Tarim said, it's very, very difficult to execute on that. They're not the kind of companies that have hundreds of millions of dollars on the balance sheet to build up a whole office infrastructure in Asia and Europe, et cetera. So our companies typically look for partnerships, people who actually know how to operate in Europe, how to operate in the Middle East, how to operate in Asia, and whether that's channel reseller kind of relationships or other types of partnerships, we are open to considering those types of opportunities for our companies.
It's great. Another question.
What advice would you give to a startup design and development agency with strengths in AI, cognitive design, and end-to-end development, but lacking funding in marketing and sales?
So you're a AI-centric design agency, and you just want to get some advice as to, you lack the funding for expanding sales. Is that correct?
Correct. So a lot of experience design, back-end, front-end development, and AI strengths.
Okay.
These are our core strengths. That's what we've been doing all our life. And now we put it got out of a corporate world and put an agency together, but struggling with our Achilles heel is basically marketing and getting funding to do the sales and expanding.
Right, maybe Usman, you
So
can.
maybe I can comment on that. We do invest in IT services, and what we're seeing in the market is what is very, very important for IT services companies, whether you're offering design, development, maintenance, et cetera, application development services. So one thing we're seeing is that it's no longer sufficient to just be a provider of bodies. I mean, we have software developers, we have designers, we can do everything you need to do. That is kind of a race to the bottom because across the world, the rate cards are coming down. So it's very hard to build a large business off of that model. So what I would say is you really have to develop either horizontal or vertical expertise. So let's say you want to go all in on healthcare. And in healthcare, you want to go all in on payer or provider or pharma and certain use cases within that. So I would say you have to have some vertical expertise and the credibility in a particular sector, or you could have horizontal expertise. So our horizontal might be defined as, we do, AI and data and analytics. So we've invested in a company called the Math Company, and all they do is data fabric, data design, data modeling, data infrastructure, et cetera. And they say no to work that is not in that category, and that's how they've grown really well. So they're a horizontal specialist. So I'd say you really have to, as early as possible, develop some vertical or horizontal expertise.
It also sounded like you were asking for advice on how to get something off the ground at an early stage from a sales perspective. I do think specializing early to get a franchise for yourself, as Usman suggested, is important. But I would also say that early stage consulting firms just don't have they're not fundable typically at an early stage, like at a pre-seed, seed stage. But the benefit you have is that your customers are your source of funding, and getting the sales in as founders is key. So I've bootstrapped, my first venture was a bootstrapped consulting firm agency. We focused on the games business. And so I ended up spending 25 years in the games business unexpectedly from that initial accident. But I think initially the founders are the salespeople and have to be until you get to enough of a scale and a repetitive sales motion with a portfolio all along a particular specialty where you have credibility to where you can perhaps consider having someone else do sales for you. But otherwise, it's all you, your network, your credibility, your focus. At least that's my 2 cents.
I'm Imran. Thank you for a very interesting discussion. I thought I'd pick something topical here, which is the election happened very recently. Do you have any perspectives on how Trump's victory will affect the tech industry and the tech investment industry? There was a feeling earlier in the year that big names in Silicon Valley were getting behind Trump, Mark Andreessen, Ben Horowitz, Doug Leone, and there has been a pushback in recent years against big tech specifically, a feeling that they were becoming too powerful. Do you think the election will have a marked impact on how the investment industry operates over the next few years?
So just to break that down, you're asking about the impact of the Trump administration on the tech industry, but also the impact of the Trump administration on big tech. Sangeen, would you like to take that?
I'm not going to make any political statements.
It's too late for that.
My mom's disappointed, and she's here. You guys already know that. Look, I've been in the Valley 20 years. I think if you look at the Valley over the last 50 years since the start of the semiconductor industry here, it pays to be optimistic. If you are going to live here, come in with unbridled enthusiasm. And so I didn't answer the question of best advice in my career, but the biggest mistakes I've made is it's easy to say this is dumb, whether it's crypto, whether it was AI 4 years ago. But I know so many people that ended up at amazing opportunities, or they went to failed startups, but incredible pools of talent came out. They made wonderful connections and they built something huge. What I would say is, if you're in the Valley, if you're working in tech, if you're investing in tech, again, I'm incredibly optimistic for the next 20 years. And part of it is AI, but part of it is, Silicon Valley does a great job of reinventing itself. When software crashed, it was 12 months before OpenAI launched ChatGPT, and everything changed again. And you're young. I have 20 years of experience. The biggest mistakes I've ever made is saying no to things. And even if you go to a startup that fails, and Tell Me Networks is a great example, an incredible collection of talent came out of it. You will meet fantastic people in the Valley. I was at a startup no one had ever heard of called Green Dot. They bought a failed startup called Looped. They put me on the Loop team, and the founder was Sam Altman. So stuff like that happens on a long enough timeline here. Remain optimistic. For the next 4 years, for the next 20 years, it behooves all the young people especially to say yes to as many things as you can, whether it sounds crazy like crypto or AI 5 years ago.
Maybe Tarim, you can take the second part of the question, which is big tech. Do you think big tech should be broken up? They clearly are big, they're having an influence.
We're operating at a slightly smaller scale than the really big tech. I think generally the expectation, time will tell, is that for large companies and for M&A, the Trump administration is better. I have no idea if that'll be the case or not. I think there's a general humility that tech needs in terms of the rest of the globe. And so the risk is not Trump or not Trump, it's populism versus capitalism. And let's be honest, tech has massive influence and massive resources globally at this point. So the risk to tech is not tied to one administration. I do think that there's just a humility around the role of tech in terms of impacting society. I think sometimes is not quite embraced in the Valley in the way that it should be, and the responsibility that comes with it. But I don't think it's going to have a particularly great or bad effect. It's sort of a broader secular trend on, tech's influence is something people are wary of in the world.
Thank you. Next question, please.
My name is Khalid Nazim. I'm from Toronto, and I run an additive manufacturing business that I founded with my daughter, mine sitting there. So my question is, do you invest in manufacturing space? And an advice for us, what would investor look in a North American manufacturing business, and would it be good for us to tie it up with an AI growth engine?
What I'd say about manufacturing is, I think back to the Trump point, I think that is going to be net good for manufacturing in North America. So that's probably a positive trend, for your business. Not knowing a lot about your business, what I would suggest on the AI front is that to be competitive, you do have to adopt a lot of these emerging technologies into, your business. to the degree that it's possible, because I think there's only going to be two categories of companies going forward in every sector, whether it's manufacturing or healthcare or consumer, et cetera. There's going to be companies that are using AI to do what they do, and there's going to be companies that are not using AI to do what they do. Just like 10, 20 years ago, you would have said the same thing exactly about software. There's going to be companies that are using software to power their business, and there's companies that are not going to be doing that. And the companies in the former category are naturally going to be more competitive. So that's the only advice I could give you, not knowing a lot about your business. So happy to talk to you offline.
Thank you.
Great. Well, look, I wanted to thank again our panelists. I especially want to thank the organizers of this event who put this together. It's great to see a fantastic audience here at 9:15 a.m. And I want to thank Omar in particular for having a bunch of people get up at 8 a.m. this morning that he doesn't like to turn up at an 8:30 a.m. event. But really appreciate all the perspectives of the panelists. And if you could put your hands together and just thank them.